We're working so hard to avoid a recession that it's actually causing more problems and more damage than a recession itself. We've actually had 7 consecutive quarters of negative GDP growth per capita. So we've been in a per capita recession for 7 consecutive quarters. That's almost 2 years. If everyone worked for the government, you'd have a socialist, communist style economy, and this is no productivity because everyone's on the gravy train. Capitalism destroys the inefficient and rewards the efficient. And if we're in an economy that doesn't do that, then we're doing the opposite. We're rewarding inefficient. I'm Lloyd James Ross, 7-figure investor and entrepreneur, and I've helped thousands of business owners and professionals turn financial stress into success. If you're stuck in old money habits, overwhelmed by investing, or unsure where to start, this is for you. I'll give you the mindset and strategies to take control, grow your wealth, and achieve financial freedom. It's time to make your money work for you. Is the Australian economy entering a recession, right? Is Australia entering a recession? And how to protect your wealth if it is. So if you stick around to the end, I'm going to give you the 6 ways where you can protect your wealth during a recession. But before we jump into that, I need to clarify a few things for you. So hit the subscribe button, and I'll do that right now. Oh, wait. Hit the subscribe button so you get the next episode when it comes bang, 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 bang. You get notified, all right? So there's some really cool episodes coming up, by the way. So buckle up for this one. What is a recession? I need to clarify this because people are so frightened of a recession, especially politicians, because they don't want to have a recession on their report card from when they served in office. So for many, many years, in fact, for 22 straight years, Australia avoided a recession. It was a long, long, long streak until, of course, COVID forced a recession upon the world, and it broke that streak. But seemingly, this word recession just strikes fear into the hearts of everyone who hears it. And I think the most important thing in this episode is to explain to you what a recession actually is. And it's actually not that crazy. People often think it's some depression. They think at the 1920s. They think if you hit a recession, everyone's going to be starving and on the streets and in a breadline. I think that's the picture that the public has been painted in terms of what a recession is by the media. But it's actually not that. It's very simple. It's 2 technical reductions in GDP over consecutive quarters. That sounds very complex, doesn't it? So let me rephrase that. It's 2 consecutive quarters. So obviously the year's split into 4 quarters. It's 2 consecutive quarters of negative GDP growth. And GDP is the gross domestic product. So how much the economy has grown for that particular quarter in terms of how much money it makes, right? And so if you get 2 consecutive quarters, then we're in a technical recession. Technically, we're in a recession. And it's quite interesting because if you were growing, let's say at 5% GDP, which is very robust growth, and it fell from 5% down to 4.9 one quarter and then 4.8 the next quarter, we're in a recession. But a 4.8% GDP growth rate is fantastic. It's incredible. So just because we're in a recession, we're falling in growth, people freak out. But then what happens if it regrows? We're good. So not every recession is, like a depression. There's a difference between a recession and a depression. And we've had some fairly deep recessions. We had a deep recession in Australia in the 90s, the recession we had to have, as Paul Keating said. And we've had we had a recession during COVID. We had a recession during the global financial crisis. So we've had a series of recent recessions historically, and we will always continue to have recessions. I promise you that. We will. So it's not going to be something we're going to be able to avoid. But it seems like we want to avoid recessions like the plague. And the hardest part about that is that we're working so hard, which I'll explain in this episode. We're working so hard to avoid a recession that it's actually causing more problems and more damage than a recession itself. And it's very akin to the metaphor of a bushfire. So like when a jungle gets or a forest or whatever it might be, the outback gets overgrown, it can start to strangle itself a little bit, and it can start to be not as productive in terms of the ecosystem. And so what happens naturally is bushfires burn through a forest and they get rid of all the foliage. And so they get rid of all the dead wood. And then it clears the forest, and then new green shoots come out, and the forest reinvigorated and regrows stronger and better. And if you look at that in terms of an economy, we've got all these like old, failing, non-profitable businesses, very unproductive businesses in Australia. We've got unproductive policy and regulation. And like a forest, we're strangling ourselves because we haven't had a bushfire come through and get rid of all these, low productive deadwood businesses, deadwood assets, and even the spending and the debt that people carry, we've become very anemic in terms of our growth because we haven't had this bushfire. And that's why Paul Keating said we had a recession we had to have. So we do have to have recessions are part of a normal growing economy. And it's very much like a business. Like if you have a business, and if you look at the actual compensation history of a business. So if I pulled up our Stripe accounts for one of our businesses, or I looked at our compensation plan for our network marketing business, or the share portfolio we have, you're going to find that it's like this. It's not a straight line. It's very, it goes up for a while and then you have lower growth and then you grow again. And every business goes through a growth phase, a maturity, and then a decline, and then it goes again. So the economy is effectively that at scale. So if you scaled up your small business, like let's say, for example, you got a hairdressing salon. Not every quarter in your hairdressing salon is just a record quarter. I'm sure you go through times where perhaps it's in winter, it's cyclical a little bit, or it's seasonal, where you'll have a really robust growth quarter and then it'll come off the ball. Maybe you'll have 2 consecutive down quarters in growth. You go through a recession in your business. So if we scale that up to a country, why would we ever anticipate or expect Australia, or any country for that matter, to go through perfect straight growth? The only thing that does that or has done that is Bernie Madoff's Ponzi scheme. And so if we've got a straight line like this in Australia, we're kind of building a Ponzi. Why? You can't have that type of growth. The real productivity gains come from when we're down and out and we recalibrate our businesses and our finances and our regulation, and we then prepare for the next growth phase. And we haven't had a recession really in Australia we're so afraid of it that we're pulling all these policy levers to prevent it, and all it's doing is kicking the can down the road. It's going to make it worse. It's already making it worse because, as you'll find out in this episode, we're actually in a per capita recession now. And so if you're feeling like you're a little bit poorer and it's harder, it's because it is. Because we're doing everything we can to avoid the bushfire that's going to come through. But, I mean, we need that. Every capitalist economy will need some sort of recession to reset itself. Okay? So that's what a recession is. I don't know why we're so afraid of it. I guess it's like when you get given something and you get it taken off you, it hurts. So when you give people a ton of money and success for 10 years or whatever it might be, and then you take it off them, they're going to be annoyed. And politicians, for that matter, like they hate it the most, because if you get a blemish on your record as a prime minister or the political party at the time, the other party can just slam you like, hey, they took us through our first recession in 20. Like, it's very, politically heated. And the mainstream media jumps on it like it's, they're all over it. I'm fairly certain that the media themselves don't even know what a recession is. They're just a recession. You see it on the papers, right? That's probably why you clicked on this episode. You're like, oh, we're going to recession? I want to see what Lloyd's got to say about this. So there you go. So I've got some data here. I'm going to share with you a couple of things. The first thing I wanted to just explain is what a recession is, okay? And then I'm going to explain briefly what a per capita recession is, because we're in one. And so a per capita recession is if you take the GDP growth or decline over the 2 consecutive quarters, or even a quarter, you'll see that the GDP divided by, or the GDP growth divided by how many people are in the economy will give you a per capita. Per capita just means per person. Recession. So it shows you that per person, we're effectively less productive. Our growth is slowing per person. And why that's important is because at a citizen level, it affects you personally. So that's why you're feeling perhaps you're growing less in your business, you're growing less in your assets, in your wealth. It's a little bit harder per person. So we are in a recession per capita because I looked at this and I was like, wow, I didn't know it was that long. We've actually had 7 consecutive quarters of negative GDP growth per capita. So we've been in a per capita recession for 7 consecutive quarters. That's almost 2 years. So we've actually been in a recession really for the last 2 years. And so what your greatest fear is, like, oh, we're going to get a recession. We've been in one for almost 2 years. So here we are. So our worst fears have transpired and come true. And really all that happens, and you may have felt this, is you may have to tighten the belt a bit. Perhaps you just got to change your spending habits a little, or it might be a bit more competitive at work, or things are a little bit more expensive. Yes, I'm sure you've felt that. So we're in one. So as a country, I feel like I'm the type of person that addresses my problems head on. So for example, if I'm seeing that our growth in our business is going to go through a decline, any of our businesses, I start cutting some of the costs. I try to be clever with how much or what we're doing to bring more income in, being more productive in the business. So actually making difficult decisions. That's really what it boils down to. It's like, well, we're going to go through a decline. I've got to make some difficult decisions, right? I mean, it happens in anything. If you're going through a challenge in your relationship, you've got to make some difficult decisions. You've got to have a difficult conversation. It's the same thing as a country. If we're going through this process where we're going into a recession, we've just got to make some decisions. And unfortunately, we don't get to make those decisions for the country. The political party in has to make them. And unfortunately, the one we got doesn't make any decisions. They haven't, there's no leadership here. Kind of makes you want to get into federal politics, doesn't it? But then you get into the fold and then you get infected by the fold. So it's not as easy as that. Anyway. All right. So we're in a per capita recession, 7 consecutive quarters. In March, it fell 0.4%. June in 2024, 0.4% it fell. September, it fell by 0.3%. So we've got this happening, right? Now, there's 2 reasons why this is happening. 2 reasons, okay? The first reason is low productivity, which I'll explain why that's coming and how that's happening. And the second thing is more people. So if you have more people coming in, you're dividing the denominator in the equation by more, you're going to have a lower number. So if we're bringing in more people through immigration, we're going to have less GDP per capita because this is more people. So if the denominator is higher in the equation, we're going to have, effectively, it's why it's causing a per capita recession. More people need more jobs. More people need more public services. More people need more housing. I'm not a big proponent of mass immigration. It destroys the citizens who are already there. But I am a believer in immigration. So I'm all about growing a country through immigration, through net migration, or obviously through natural births. And a growing population is great, but not unchecked immigration to then throw them into low productivity jobs, which I'll explain. So I'm all for immigration, but we don't have to go crazy with it, right? It's the same sort of thing. Like if you're inviting your family up for Christmas, you want them to come, but you don't want all of them to come at the same time. Like imagine if like 55 of your family go, oh, we've got one house, we've got no beds. That's kind of what's happening. Like, yeah, I want people to come, but not everyone at once, right? And certain people and for certain reasons and so forth. So there's 2 things, low productivity, the first thing that causes it, and then the second thing, more people. So let's look at low productivity, all right? So we look at jobs growth here, and we look at where the jobs are growing to show, well, what productivity gains are we going to have with jobs growth? Now, what's really interesting about this is recently the June unemployment rate rose to 4.3%, and it just shocked every economist. Like, what? I thought unemployment was going to fall. They weren't expecting a rise in unemployment, which is kind of surprising, actually, because if you're bringing more people here and you're maxing out the jobs already, we're a low productivity country, you're not going to have a lot of people filling roles. So you're seeing already that immigration and unemployment are connected, okay? So you're bringing more people, not as many jobs, of course, unemployment goes up. Now, what's interesting about this is the part that is most important about productivity is where are the jobs? Because if you want to have a highly productive country, you put them into growing sectors in the economy. Generally, it's through business activity and innovation and effectively non-government jobs. That's where you get a lot of productivity because we all know, if you've ever dealt with a government entity of any kind, you know how incredibly ineffective and low efficiency they are. You know, like you deal with the government, anything, it's just, the efficiency is terrible. So the same sort of thing happens in jobs. It's just not a highly productive space, right? So you look here in the data, the amount of employment, so private sector or public sector jobs, this comes from the ABS. There were a total of government-funded roles such as healthcare, education, public administration. In 2024, there were 373,100 jobs added. In the private sector, so the market sector, so it's business-driven employment, where it's the most productive because of capitalism, it's approximately 113,900 jobs. So you're looking at, 77% of all jobs created last year were in the government. In this really non-productive, it's not creating anymore, it's just facilitating and servicing the people here. And it's being paid by the taxpayer. So what happens when that happens is that everyone in the economy, including the public sector, but those private businesses building all this new growth, a lot of their tax revenue is getting thrown into the government-funded jobs. So we're almost robbing Peter to pay Paul a little bit. And when that happens, you get low productivity gains. Okay, it's just the way it works. And so, for example, if everyone worked for the government, you'd have a socialist, communist-style economy, and there's just no productivity because everyone's on the gravy train. It's a little bit like having, like let's say is a family business and only anyone who worked there was in the family. And of course, you're going to have family members that are lazy, that trying to take advantage. And you think about those who are working in government, they're not there to be productive. A lot of people, I'm not saying just government, but people in a employment style that are unchecked in terms of their review and so forth, they're trying to do as little work as possible and make as much as possible. That's just human nature, right? That's the incentive structure. Government style roles, I'm not saying all of them. So if you're in government, don't freak out. Like Lloyd hates the incentive systems in government and the checks and balances just make it inefficient. They hold people they shouldn't do for too long, and because they're funded by the government, there's no natural attrition in the sector. So for example, if certain quotas aren't hit, no one loses their job because they need certain roles to be filled and so forth. So you do get a very inefficient economy when you're piling people into the government sector. And you don't really want a full socialist government or communist government. There's a reason why when the Berlin Wall, if you're wondering why, and if you're someone who's like, well, we want more socialism and power to the people instead of the rich people and more government jobs and communism, I don't know where this came from, but it seems to be more prevalent today than ever. In the 50s, you get arrested for that type of talk. But there was a reason why when the Berlin Wall fell, that people from the East fled to the West. That's when the Berlin Wall fell, there was no one running from the West to the East. Does that make sense? There's no one running from South Korea to North Korea. Like, I hope I can go to North Korea. That looks like fun. No. It's not how everyone's trying to flee. They're trying to get away, right? Just quickly, if you're ready to take control of your finances but feel stuck on where to start, I have a solution. My book, Money Buys Happiness, simplifies investing and wealth building with practical steps to help you achieve financial peace. Get your copy via the link in the show notes and let's get your money working for you. Now back to the episode. We want as many private sector jobs as possible. We want as much business market type jobs as possible. We certainly don't want 77% of them going into the government sector. No way. Not for a productive, healthy economy. And the reason why that's happening too, I think, is, well, without doubt, when you're immigrating a lot more people, you're going to put pressure on the healthcare system, the infrastructure, and public works. You're going to. So for sure, you need people to fill roles to then service those people coming in. But I also think the immigration minister and obviously the prime minister and the government, they all talk and they say, well, look, we don't really want a recession in our books here. So can we just bring some more people in? And can we just give some more jobs to the government sector so that we can prop up the employment numbers, so we can keep the momentum going in employment? Because no political party wants to say, well, unemployment spiked during my prime ministership, right? So they're kind of in cahoots. Like, let's give more jobs. And of course, if you have things like the NDIS program happening, you're creating, you're funding this particular sector, you're going to find a lot of people coming into that to fill roles because it's a created thing by the government, right? So anyway, the reason why that causes a per capita recession is because there's more people coming, right? So the next part is the immigration component. And you can see they're very, very closely related, okay? If we look at now that unemployment's gone up recently, now they're threatening a cut at the Reserve Bank because unemployment's going up. We can't have that happen at all. I mean, no one wants to lose their job, but when you're immigrating people, it's just going to happen. It's a byproduct. So here we have the next part of the equation. So low productivity is the first thing, and it's the type of jobs being created that create low productivity. So we've established that too many government jobs are creating a low productive economy. The next part is migration. And so in the year ending June 2024, so the last financial year, the net overseas migration into Australia, so that's like immigrant arrivals was like 667,000. The departures were 221,000. There's people that leave here too. 221,000 left. The people that are left over is net migration, and it's 446,000 people. Okay. Now, what's interesting about that is it was down by a lot. Probably about 20%, it looks to be. It was down by 20% from June from June financial year. So from June 2023, it was 536,000. June 2024, it was 446,000. So you see it did drop, which is what you really want. If you're a citizen in a country and you have all the wonderful natural resources that we have, you should be happy not to have a lot of migration, truly. Like, there are countries in the world that don't have a lot of net migration and they have wonderful lives. It's just not the be all and end all. I think that the lobbyists and certain people in certain sectors like the property sector, they lobby hard for more people because they know it's going to pump up prices. And that's what they want, right? It's just the greed factor that causes it. That was that year. Now, what's interesting about that is since then, it's gone back. Well, it's certainly not gone back, but it's risen a little bit. So it's like 447,000, 448,000 are coming in the last year or this year specifically. So we're seeing a lot of migration come in. And everybody knows, I've done episodes on this before. If you haven't seen some of the episodes, go back and have a watch of them as to why this is a problem in our country. But of course, if you bring more people in, then especially if you're giving away 70% of jobs to the government, you're going to have a lot of people coming in and just joining the government. It's like, just join the gravy train. And they're not providing any efficiency to the economy, not in sectors that are going to grow our GDP, right? It just sucks. It just takes more tax revenue from every single person to facilitate their employment. And it's what's causing this per capita recession. Now, what will happen over time if we don't fix this is we're going to go through actual recession. There's two things that the government can do. There's two big levers that they can pull to prevent a recession. The first and biggest lever they pull is the interest rate lever. Or any what's called monetary. So the two levers are monetary policy and the other lever is fiscal policy. Monetary policy, that lever is effectively where they can move interest rates to. So monetary policy is where if you pull the lever, you flood or restrict the economy with money. That's called a monetary lever policy, right? And some examples of that are if you move interest rates down, it makes debt cheaper, it makes savings accounts less effective, and people spend more money. So when they drop rates, they stoke the economic fire a bit, and they release money through the low interest rates into the economy. Because anytime someone borrows money from a bank, money's created, okay? Or with the monetary policy, they pull the lever, and the government spends more money. So when there's government spending, that's a monetary policy tool. And then the third one is they're also buying bonds, okay? So quantitative easing is when they're doing that. So if the government's buying bonds, they're quantitatively easing the economy. They're releasing more money into the marketplace. So there's three things they do. It's interest rate, it's government spending, and then it's quantitative easing, okay? Quantitative easing. So those three tools they pull are monetary policies. And they pull them if they want to invigorate the economy and grow it. So recently, if you see in the news, the cash rate or the interest rate, the Reserve Bank, the RBA, the Reserve Bank of Australia, if it's the Fed in America, every country has a central bank, and you'll see in the news, interest rates are 3.85%. That doesn't mean your interest rate in your bank is 3.85%. 3.85%, the RBA rate is the rate at which banks borrow and lend with each other. It's the overnight rate, okay? How that affects you is it dictates the retail rates that the bank sets. So if the bank can borrow from other banks or institutions at 3.85%, it can then lend out to you at 5.8% or and take a 2% margin. It's called the net interest margin, and it's how banks make money. So a bank will borrow at 3.8, it'll re-lend at 5.8, and it takes a 2% net interest margin, and that's effectively how banks like CBA and Westpac and so that's how they make money. Okay, so what will happen is if you see in the news, interest rates are going to fall. That's because the government's pulling the monetary policy lever to flood the economy with a bit more money. Got it? They are also spending a lot of money, too much money. You can tell this if you get your tax return for the year. This is a fun exercise. And you hold it up on the back of your tax return. You turn it over and you'll see exactly, they break it down where they're spending your money. And you'll see, so let's say, for example, you got a $25,000 tax bill. You'll see $10,000 in health. You'll see $4,000 in military. You'll see, the biggest one is, you probably see $5,000 in health, $3,000 or $4,000 in military, and you'll see $10,000. Like, where the hell is that going? Welfare systems. That's the government just giving the money, right? It's social security, it's all these things. And it's old age pension care. So a lot of your money's going there. But what happens is the government, if they're spending money, your taxes will go up. There's no such thing as free. They go, everyone's going to have free health. Nothing's free. We all pay for it through our tax. So you'll see when the government's spending through monetary policy lever, you'll see it come up in your tax, right? And they love to spend money because there's no checks and balances. There's no one holding them accountable. You say they're held accountable when you go and vote, but the reality is this is not the way it is. So they're going to pull that lever. And also, if they want to do quantitative easing, which is what they did during COVID, they'll also do that to flood more money into the market by buying bonds, okay? When they buy a bond, they put money into the bondholders' hands, and that's how they do that, right? And so, well, they'll be pulling one of those levers. And when they do that, they stoke the economy. So at the moment, if you see them going to drop rates, then they're trying to restoke the economy to avoid a recession. The issue with that is any of those monetary policies or levers they pull, they stoke inflation. And so, yes, you can have 3.65% interest rates if you want. By the way, if they take 3.85% and they drop it to 3.65%, your savings on $1 million loan mortgage is $200 a month. Like, it helps. I know it's $50 a week, but you're going to find you're going to pay $8 for a coffee then. So it's robbing Peter to pay Paul. You're going to find if they do that too much, inflation rises, it's going to hit you anyway. It's a pernicious tax. So you think you're saving money because the rates are lower, but then you get hit with cost of living. You go to the supermarket and lettuce costs you so much money, it's because of that. So you got to be careful what you wish for, right? People are jumping up and down. I saw someone the other day jump up and down when someone they were doing dances when they cut interest rates. What the hell? Yeah, so yeah, you can have lower rates, but you're going to get $8 coffees. So I don't think that those particular monetary tools are effective. The other side of the fiscal policy lever that they can pull is how they manage the tax. So if they shift tax regulation, they can also stoke the economy. And I really feel personally that would be the lever that I would pull if I was in power, because it incentivizes businesses. And businesses are the bedrock of an economy, in my opinion. Big ones and small ones and medium-sized businesses. So if you pull that lever, like for example, Melly in Argentina, he's got this wonderful tax lever that he pulled. Check this out. Anyone who's in business, they don't pay tax up to $75,000 of their first amount of money. That's an amazing incentive to get into for businesses. So he's pulling the tax lever. Also, if they reduce taxes across the board, they're also able to release money into the economy through incentivizing business activity to do it rather than just flooding the economy with a monetary policy over here. So instead of just giving cash like that or opening it up, they can actually incentivize businesses to produce more by reducing the tax revenue. But they don't want that because we want more tax. They're just trying to get so much tax. But if they pulled the right fiscal tool, I think they would fix the efficiency of the economy. So anyway, I don't know how I got onto that, but it's important that you know these things. So to avoid the recession, they pull a monetary tool, lever, they pull a fiscal lever, or they flood people into the economy to prop up the population growth. And that props up things like rents and it inflates the economy effectively, which does do certain things to reduce the chances of a recession. But especially if you've got unemployment going up and the RBA goes, let's drop rates, you're going to avoid a recession. So it seems to me like the objective of the government right now, and has been for the last few years, is no matter what we do, let's avoid a recession because we can't have it on our car. And so what's happening is we're getting all this inflation, rent's out of control, housing's out of control, lettuce is out of control, coffees are getting out of control, and it's not good for the citizens. I'm a big proponent in is they should have left rates at 4.1% and let unemployment go up a little bit and some people to default, because people are in poor financial condition because they've made poor financial decisions. And, unfortunately, you gotta pay for those bad decisions that you made that weren't effective. Like, if you went out and borrowed to the hilt to buy multiple properties and you're struggling, well, that's a stupid thing. Why did you do that? What did you think what did you expect, to rub down in a shiatsu? Like, that's what happens when you make dumb financial decisions. And even businesses that unfortunately are being propped up by this anemic economy, this fake growth, they probably shouldn't be in business anymore. We need to have defaults. We need to have businesses being wound up. That's capitalism. Capitalism destroys the inefficient and rewards the efficient. And if we're in an economy that doesn't do that, then we're doing the opposite. We're rewarding inefficient. It's a little bit like you've got kids at home and the one that behaves well, you take off them, and the one that doesn't behave well, you encourage them. That's effectively what is happening. I don't think it's good for the economy. So how do you avoid, or what do you do? How do you navigate? What are the 6 steps that I mentioned that you can do to navigate this per capita recession, or navigate the next recession that is going to come, which it may well do? Because if they pull this monetary lever and drop interest rates, and they drop them more and more and more, and growth doesn't come, then we hit a period called stagflation. And this is what happened in the 1970s. You get rising inflation, no productivity growth and no GDP growth, and all of a sudden you have no more levers to pull. And you get stuck in an anemic growth pattern for the foreseeable future where it really sucks. And Japan has been stuck in there for like 30 years. And what's interesting about that is for that 30-year period, Japan has had no housing growth. It's been a real struggle. They've called it lost decade, but effectively it's the lost 3 decades. And they've really paid for that. And so we don't want to fall into a period of stagflation, which will happen, right? I think, hopefully it's not going to happen with us, but we have a lot of resources here that per capita that we can get out of it. So best way to navigate it. 1, build a cash buffer. So 3 to 6 months worth of expenses will allow you to have some liquidity if things get a little bit challenging. So if you've got that boat, that second car, that second property investment that's losing money through negative gearing, and you're waiting for capital growth to offset it, which it won't from here going forward, in my opinion, then the answer is go sell some stuff and build up this cash buffer. When companies get into trouble, they liquidate some assets. That's how they get back ahead. So build 3 to 6 months of expenses for emergency. That's the first step. Second step, slash your high interest debt. So if you've got credit card debt that's not producing any income and it's like 17 or 18%, then perhaps sell some of those things to pay that off because it'll give you more free cash flow at the end of the month, okay? Third thing, I would say diversification is important. So the third step is to diversify. But I would say not diversify necessarily just assets. You know, people talk about going to bonds and so forth. I think just having a cash buffer is a fine diversification. Diversify your income would be the area in diversification that I would go with. So like, for example, if you're anticipating a flood, the idea is to build an ark based on the biblical story of Noah before it floods. That would make sense. Would that make... In the story of Noah, I'm pretty sure he started building the ark like 70 years before the flood. So God's telling Noah, build the ark, build the ark. He's building this ark and everyone's like, you're a crazy person. What are you doing that for? It's not even raining. And this is how people approach their finances. They wait for the storm and the rain to pour and it's like, it's raining. Oh, there's a flood. Oh, maybe I should build a boat. Well, if you try to build a boat in the water, it's very hard. I don't know if you have, but it's not an ideal place to build a boat. Where do they build boats? On the land when it's dry, and then they put them in the water. So diversifying your income now would be akin to building an ark before it rains. So if you're anticipating, or shivers, what happens if these monetary policy decisions they make aren't going to work for us and we're getting more people, it's more competitive, what do? Go get a second income. Develop a second income. You work evenings, weekends, now's the time. Now. Build the ark before it rains, not after. Fourth step, lock in an effective strategy. So this is part of the strategy. So it's like locking in, these are the steps I'm going to take, yes? But then voice it with your spouse, have a plan, say, hey, I just watched Lloyd's thing on YouTube, episode about maybe we're going to hit a recession. Honey, things might get a little bit trickier. Why don't we implement this strategy and stick with it, right? So lock it in and execute that strategy. This is an interesting one too. I'll put some notes before this. It's like stay vigilant and informed. But basically stay informed on what's happening so you can make decisions. Because how you make financial decisions is you get data and then based on the data, you make a decision. And I think what happens to people's finances is they make kind of reactive emotional decisions with no data. It's like if you're not looking at your bank statements every month, you're not looking at the data, the economic data that's happening, you're not looking at your private business, you're not looking at your real estate, you're not looking at things, you're going to not be able to make effective financial decisions. Like you'll be making emotional ones, right? That's why it's important to have a plan. Step number 6 is to, if you haven't done so, educate yourself in the realms of finance and money so that you can understand what to do when either there's a recession, there's opportunities, or what to do if there's a recession and you find yourself in a bit of a bind. Either which way you go, you have to understand the basics around money and financial literacy to make better decisions, which is why you're here listening to this channel, which is amazing. So well done for jumping in here and listening to this all the way to the end in terms of what a recession is, how to navigate it, and educate yourself because it will help. A small little bit of information and you educating yourself and leveling up will make such a massive difference to your financial future as you go along, but also to your kids. And it's such a good use of your time. So if you haven't done so yet, hit the subscribe button, leave us a comment. I've been having so many wonderful comments in our YouTube channel, which is now growing spectacularly. Thank you so much for helping us grow the channel and your support and hitting the subscribe button. We're growing in subscribers. It's so much fun to see. But I love the comments. And if you haven't seen yet on our show, I go in and reply to almost every comment. And there's some really funny ones. If you go to the comments and check it out. And if you're someone who wants to leave a funny one or a savage one, be my guest. I do come and reply even to the savage ones. There's a guy the other day left a comment, just absolutely just roasted me. I was like, oh, he's probably a good person. Hey, you want to go for a coffee? And I left my mobile number there. So, and I don't care. I'm a very transparent dude. So if you want to leave a savage comment, I'm probably just going to leave my mobile number and say, hey, let's go for a coffee. Because, you're not a bad person. It's just we have different opinions, and I think it's important that we can talk about those opinions. So if you don't agree with me, please leave a comment. And the savager, just go for it. And I'll come back and I'll reply. And I don't hold back either. So if you want to fight me, go to the comments and fight me. But if you want to leave a fun, encouraging comment and you agree with me on these things, also leave a comment. So I thank you for those who have done that. There's a guy the other day that bought our new book, Become Time Rich. And he actually bought the book and he read it and he left a comment and he goes, you hear the people that do channels and you buy their book and it's full of blah, blah, blah. And he said, I actually read the book. He goes, it was really good. And so I said to him, well, if you send me details on Instagram, I can shoot you a signed copy. So there you go. Bit of an incentive for you if you want to buy the book. So there you go. So hope that makes sense. Leave us a comment below. Hit the subscribe button again. And go and check out the previous episodes I've done around the Australian economy. But the stuff I'm talking about applies to most other Western economies as well. So if you're in the States or in the UK, the same sort of democratic, capitalist countries, we have the same tools. We're playing the same game. So it does apply to those countries as well. And we've got some really cool episodes coming up, right? So make sure you go forward and check out the next ones if you've enjoyed this. So thanks again for tuning in to the Money Grows on Trees podcast, and I'll see you in the next episode. Thanks for listening to Money Grows on Trees. If you enjoyed the episode, leave a 5-star review on Apple Podcasts and Spotify, and subscribe to us on YouTube so you never miss an episode. And if you're serious about building wealth, make sure to check out the links in the show notes and follow me on all social media platforms at Lloyd James Ross for more. See you in the next episode.